Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Welltower Inc. and do a stock analysis on them. And Welltower, they are a REIT that is primarily in senior housing and medical facilities. And as you can see from the little chart on the right here, they've ran up quite a lot in the last few years. As early as basically 2023, they were sitting around $70. Now they've run up to $210. What we're going to be doing is we're going to be going over why the stock has run up so much currently, if it's a good value, or where it may be a good value in the future, and show a good way to analyze stocks like REITs so you can easily see if they're good deals or not. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you like looking at individual stocks and want to get good ideas for potential stocks to buy or value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a stock, basically leave it in the comments below, as I do frequently get subscriber requests. Now, basically looking at Welltower Inc., you have to realize they're a REIT, and looking at a lot of the traditional metrics like PE are not a good way to look at it, since basically PE factors into depreciation. And with real estate, as many people know, well, you depreciate a lot of the value. That value isn't going down. Your cash flow isn't actually going out of the pocketbook of the company. So what you have to look at instead is the FFO, which is the funds from operation. But either way, right now, you can see the PE sitting pretty high at 150, and the FFO is also sitting pretty high at 77.86. And additionally, typically REITs are bought by dividend investors, and you can see right now they only have a dividend yield of 1.38. So kind of even off some of the first fundamental looks here, it is looking like it's a little bit more at the expensive side. We're still going to look into the financials here and look at some interesting basically things about the stock and things that I think that you need to basically look at when you're looking at REITs especially. Now, the first thing is you have to basically notice, well, the revenue actually does look like it's growing quite a bit. You do need to realize frequently REITs are issuing more shares to basically purchase this real estate. So you obviously really need to be looking things at a per share basis, because the overall revenue trend does not actually tell the whole story. So we can go up here and we can kind of get an idea, and let's go on, kind of a longer time frame here, see what's happening on a per share basis. And you can see basically we have the EPS here without the NRI, which is non-recurring income. And let's just drag this forward so we can kind of see from 2002 to 2025. So EPS, it's gone up a little bit, not much. You can see basically the free cash flow per share pre-2010 was actually negative, but then it's gone positive. But since actually then, it actually also hasn't increased very much. And our FFO, which is kind of the important thing, you can see the FFO has marginally crept up, but right now or at least the year before, we're sitting at 359. It's sitting slightly lower now, but that actually isn't too different than what's been in 2014 and 2015 and even some years before. So what really basically is driving up a lot of the value of the share price is over the long term, the one thing you can see is the book value per share. So this is actually some real value that is being added to the company, since not only are they basically issuing shares or potentially taking out debt to grow the real estate portfolio, they are additionally, taking some of their profits and reinvesting it back in. So a lot of the value you do have to look is based on their real estate, basically book they have. And you can see it's basically grown from a very low level in 2002 to $22 per share. And now it's up to $60 per share. But basically, as we go into the balance sheet here, and we can see basically the total equity, and we can see basically right now it's sitting at about $43 billion, which has grown significantly. You do have to factor in this is the depreciated amount, and the actual real estate is probably going to be worth more on the street. And I'm not even going to look at if they were to sell it the whole company as a whole and the enterprise value. And I kind of came to the conclusion from a little bit of research that if they were, for example, just to value their property, selling them on an individual basis, this might actually be worth about 50% more. So you could kind of say their total equity in the company is about $60 billion. And if we do compare that to the market cap right now of $148 billion, that kind of does give us a starting point to look at the company and come up with a valuation. You can take a dive into the cash flow statement here, and you can see basically what I was saying about the depreciation, because this is one of these things that's really knocking down the net income, and how they don't really have to do any purchase of plant, property, and equipment, at least these days in their business model. Before, they're maybe investing more in that and expanding their facilities, but now they're more kind of purely on a pure acquisition basis been going forward with a very large acquisition of $14 billion recently. And, anyways, that basically just explains why the PE or the net income is relatively low, but the FFO is a lot higher. And the other thing to basically look at is, which is important, is you want to look at, the cash flow from dividends, because, for the dividend investors, we kind of have to actually see if they are paying out a reasonable amount of their free cash flow, if they can afford it, and, what you can actually expect for, if there's going to be dividend cuts or dividend raises. And if you kind of look at the free cash flow here, you can see that the cash flow from dividends is certainly affordable. It is under it, but the amount, but it isn't by too much in the long run. Typically, stocks like this, they do pay out a very large amount of their dividends. So there basically is some room to raise the dividend, and with it being extremely low, that would be good. But if we do actually then go to, because, well, they are raising the dividend, this actually isn't on a per share basis. Because the interesting thing is we go over to the dividend tab here, and you can see, well, there's, like basically 41 years of dividend history, and, the forward is a little bit higher. The growth rate over 5 years, because of the share dilution, has only been 1%. So overall, like, you kind of have to judge these REITs and their portfolio they have. And one of the reasons why you want to actually grow them, even in this way of expanding the shares, is having a more diversified portfolio and more properties does make things more predictable versus having less properties. And that probably is one of the reasons the stock actually has fetched a higher value as things have gone forward in the future. And I'll kind of show that in a few different ways. For example, if you look at the dividend yield, and you can see if you actually bought this stock in the 90s, you would get a very, very high dividend yield. The low side before, it was around an 8% dividend yield, and the high side, you were getting up to 15% basically in 2000. But over time, that's gone down as the company's got more predictable, and additionally, interest rates have gone lower as well. And you can see right now it's sitting at a very low, measly dividend rate of 1.38. And you can see even in the recent past, typically, kind of the high side of the dividend yield was more of this 6%, 7%, maybe even a little higher during COVID. And one of the things I always say, looking at relative valuations for predictable stocks, well, if you basically bought it whenever the dividend yield was like relatively high, you would probably get a good return. And you can kind of see on this chart here how the dividend yield does inverse basically the stock price. So, that basically does remain true. And when you're sitting at an all-time low dividend yield, and they do seem to be paying out a normal amount out of their cash flows there, it kind of does hint that the stock is possibly a little bit overvalued. Next, we can look at the price to sales ratio, which is also a nice way to look at it, because we actually go back and this becomes a little bit basically more consistent. You're kind of seeing right now we're sitting at 13.41, which very obviously is a very large premium to basically what it was in the past. Before, it was typically trading more at the range of even as low as, around 3 here, and the highs of 10. And kind of all the good times to buy it. If you're getting below 5 or even below 6, you probably were able to actually buy it at a good price. So when we're talking 13 here, this is kind of looking at least double the value we would want to, possibly pay for the stock. Next, we can basically look at the price to book value. And because we've already said the equity is probably worth more on the balance sheet, we could actually probably say the real book value is actually about 1.5. And we see a very similar chart here, and also considering that we were seeing the book value per share basically grow, that's where a lot of the value is. That actually is a lot how this type of stock is being priced. So I think the price to book value, once we adjust it for, the true kind of value, because you're always looking to try to get it under 1, you may never buy the stock. But then if you realize that, hey, this stock, maybe its real book value is actually around what's 1.5 that we see, that kind of starts making a lot more sense. As then all these dips here, when we have got to a little bit 1.5 or below, that's been an excellent time to buy the stock, because actually at that point, you're probably paying a little bit under book value. And with that, and the lack of kind of like actual share growth they've had, or EPS share growth they basically had, it kind of does make sense that, you buy it at book value, you get a relatively good dividend yield, and that's being your overall return. But we will kind of go into the analyst estimates here, because one positive basically catalyst, if I can get some of these other things to disappear, is that as we bring up the EPS, earnings per share with estimate here, they actually are expected to, according to analysts, surprisingly grow their EPS, earnings per share, or again, we're taking into per share here, kind of above levels that they've previously been holding in, the previous holding range for the last all these years. So the one positive basically upside the stock, could basically experience is not only are you going to start seeing your book value basically grow per share, they could actually provide some more earnings per share at the same time going forward in the future. But it really doesn't justify this really high price now. But I think from everything we've basically looked at, it really doesn't. And if we go into the little stock chart here, basically this is the overall trend I have. And really you can see it's actually extended outside the previous channel I had, which I think is a pretty accurate representation of its growth. But this is not always, completely uncommon. Sometimes you basically overextend in one direction, and then it's not entirely, uncommon to overextend in the other direction. So, personally, I would be looking for the stock to come back to actually do under $100 because I'm not very interested in REITs, and when you kind of get really overextended, which seems really, really expensive, I think there's a lot of risk basically buying the stock because, what are your positive catalysts? You're getting effectively no dividend yield, and there's potentially a lot of downside if there were ever a little bump in the company or reversion more to back a normal book value. But, I'll just go over one other reason that this stock basically has probably run up so much. Because if you look at the institutional ownership, and if we go to the ownership tab here, you can see right now there is a 97%, over 97% institutional ownership. And the thing with institutions is, scroll down, they're typically actually just ETFs that are kind of, buy and hold forever and go off the passive flows of it, like the funds there. And over the last few years, basically that institutional ownership has crept up and continued to creep higher and higher. So because of that, they're buy and hold, they don't sell. It's very easy for the stock to keep rising up. But then when you do get that little speed bump, you can get that little flood out of basically the institutions. And because there's so low liquidity, especially at the high prices, it can really drive the price down. Like, for example, if you look at the past year, there was a dip where institutional ownership had a very, very quick drop from, in 2018, from 81% down to 34%. And what happened to stock in 2018? Well, it was more reasonably valued, but it, did take a pretty significant dip all the way down to basically this 200-month moving average. So just because the stock is, higher now, it doesn't mean that it's only going to have a small little dip. You can actually still revert back down to where the market actually sees the value, which typically is these longer term lower moving averages. As you can see from the technical perspective, a lot of the time the 200-month moving average here, there, basically during 2020 it undercut it. 2009 it got to it. You had a little bit of an undercut basically in 2000, and even going back to 1996. So anyways, that kind of gives you my thoughts on Welltower Inc. I think even just that, the quick, over top view, it is glaringly on the overvalued side. But in the short term, overvalued stocks can keep getting overvalued, but you always basically have to factor in the downside risk. And that's something I see a lot in Welltower. Although, like all the stocks I say, obviously I'm covering it, so I am watching it. And if it were ever to come back to a reasonable valuation, maybe around this 200-month moving average, that is probably where I would look at buying the stock because REITs are very predictable. And a company like Welltower does have actually a very good portfolio. They've been buying some properties, they've been selling some, really consolidating it. And because of all the different properties they have, it does bring a lot of stability in it. So this would definitely be, a good stock to buy at the right price. But the right price does not look like it's right now. So anyways, I hope you liked that analysis, gave you a few insights. Make sure to subscribe to the channel and like the video.